Welcome to Thoughts on the Market. I'm Michael Zezas, Morgan Stanley's Global Head of Fixed Income and Thematic Research. Today on the podcast, some initial thoughts on the market implications of a second term for President Trump. It's Wednesday, November 6th at 2 p.m. in New York. As it became clearer on election night that former President Trump was set to win a second term in the White House, markets began to price in the expected impacts of resulting public policy choices. The U.S. dollar rallied, which makes sense when you consider that President Trump has argued for higher tariffs, something that could hurt rest of world growth more than the U.S. U.S. Treasuries sold off and yields rose, something that makes sense given President Trump supports tax policy choices that could meaningfully expand deficits. And U.S. equity markets rallied, led by key sectors that could benefit fundamentally from extended tax breaks and deregulation, including industrials and energy. But with a second Trump term now at least partially reflected in the price of markets across assets, it gets harder from here to understand how markets move. There's several key debates we'll be tracking. Here's two that are top of mind. First, how will tariffs be implemented? Per the work of our economists, higher tariffs can raise inflation and crimp growth. They estimated that a blanket 10% tariff and 60% tariffs on China imports would raise inflation by 1%, and dampen GDP growth by 1.4%. Some pretty big numbers that would really challenge the soft landing narrative and positive backdrop for equities and other riskier assets. Other approaches may carry the same risks, but to a lesser degree. Tariffs exercised via executive authority would, in our view, likely have to be targeted to countries and products as opposed to implemented on a blanket basis. So, the approach to tariffs could represent a substantial difference in the outlook for markets. Second, how quickly and to what degree might U.S. deficits expand? Our presumption has been that fiscal policy action, regardless of U.S. election outcome, wouldn't become clear until late 2025, largely governed by the need to address several provisions from the Tax Cuts and Jobs Act that expire at the end of that year. But, while not our base case, it's of course possible that a Republican congressional majority could deliver on tax cuts earlier, and perhaps even in larger size. The resolution to this debate could make the difference between yields climbing even higher than they have recently and taking a pause at these levels. Bottom line, as the election ends and the presidential transition begins, there's a lot about policy implementation that we can learn to guide our market strategy. We'll be paying attention to all the key policymaker statements and deliberations and feed through the signal to you. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen to podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.